From the morning reading, the broad market in a three-day bull flag. Hammers form as buyers step up. Breadth weakened compared to the prior session as decliners led 2,099 to 915 on the New York Stock Exchange and led 2,059 to 848 on the NASDAQ. There have been few times in history like the current. Most of our indicators and studies have failed to lead to any weakness in recent weeks, despite strong suggestions that the risk-reward ratio was poor. The three other times we saw similar failures led to impressive gains going forward, but on almost every metric our current situation is more extreme than the others, suggesting they are not necessarily good precedents. Another measure of momentum has wobbled. For the first time in more than 2 months, there are more new 52-week lows than 52-week highs on the New York Stock Exchange on Monday. When stocks were recently at a multi-year high, the ends of similar streaks led to some very short-term weakness, but were not a consistent signal. Silver is facing a tough row to hoe. The smart money is at a near record short exposure, while options traders are betting on a further rally and seasonality is about to peak. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:30 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 7th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and get over to the morning report. And at the time of this cut, a bit of weakness, but nothing significant. All four of the U.S. broad-based indices are down just below scratch. And on volume that's not terribly significant. Crude oil's up about 0.4%. Euro's down just below scratch, as is the long bond. Gold is down almost 0.25%. China is up about 0.25%. Hong Kong's up about 0.33%. Japan's down just below scratch. And Germany and the United Kingdom are rotating right around scratch. In terms of macroeconomic reports for today for the United States of note, you have trade balance, and that'll be before the market opens. And that looks to be about it. In terms of looking forward to tomorrow, things start to heat up a bit. We have non-farm productivity, unit labor costs, ADP non-farm employment change, crude oil inventories back to its normal Wednesday, a 10-year bond auction, and that looks to be about it. So pretty quiet at the beginning of this week, but Wednesday definitely heats up with a lot more economic report activity of note. In terms of current volatility conditions, short-term VIX at 9.67. Skew continues to elevate, and it's now crossed the 140 threshold, so at 140.17. IV percentiles continue to be exceptionally low. The S&P at 11, the Russell 20, the NASDAQ at 3, and the Dow at 22. One of the indices had a standard deviation size move on a close-to-close basis yesterday, and that was the Russell. And indeed, the Russell's been really quite volatile in recent trading. In the last 6 trading sessions, we've had 5 which had at least a 1 standard deviation size move. The other thing of interest here is note that it's going both directions. In the last 6 sessions, +1, -1, +2, -1, less than a standard deviation move, and a -1 standard deviation move is the most current trading session. So a lot of action there. We'll take a look at the chart here in just a second. In terms of the S&P futures, you see what the morning author was mentioning, a 3-day bull flag. And unless this breaks down and comes down here, we mentioned this yesterday, really down here below this 2350 to 2340 area, this is just a continuation pattern and really nothing else to be expected of it. Now, we've seen some evidence of weakness across the market in recent sessions, and it's tempting to think more of it than perhaps it really is. At this point, this is nothing but a continuation pattern until proven otherwise. And the risk profiles, as we look across the various risk parameters that we follow, there's not much flagging at all. Same thing on the Dow. Dow looks to be in a classic bull flag pattern, an expectation that you're going to get significant weakness from the Dow or the S&P. There is not a lot of evidence to that at this point. Now, if things start to accelerate and build on themselves, certainly we'll take note of that, and we'll start changing our assumptions. In terms of the NASDAQ also very strongly bullish and is also in a bit of a continuation pattern. Lots of support below this. If anything, we might start to see these indices start to shallow out and their angle of attack become, more normal at the very least. The Russell, of course, is in its own little world. It's been very, very sideways in recent months, ever since that huge post-election rally. And it clearly is back into the trading range now. While I would continue to suggest, as I have recently, that upward resistance is probably relatively weak because we've already plowed through this area and spent quite a bit of time up above the former area of resistance. The market here is clearly back into the prior trading range, but there's also a lot of support down here below. So don't really see a lot of energy here yet to make a significant down move, and yet at the same time expecting that the Russell's going to make large up moves anytime soon doesn't seem to be in the cards either. In terms of other markets, we'll take a look at crude oil. Crude oil's been trapped in this sideways protracted range, and it still seems to be exactly in that condition. And just a second here. There we go. Gold does seem to be the mover. We've talked about this one has been the market that has been in a trending action when many of the other markets were in sideways markets. And you notice we've had the big trend break here in the intermediate and short term, started to look very bullish. We had the cloud breakout, and as soon as we got that cloud breakout and really started to really put some series of higher highs and higher lows, it started to look like a real intermediate term trend. We get this pretty significant retracement here. Gold has had very significant retracements that seem to overshoot the expected just to then continue. So the question that we now have and still have is this the overshoot, or are these mild pullbacks at this point, just simply pullbacks and a continuation of a bullish trend? The dollar might be part of the key to what this is, and if the dollar starts to make runs back towards the all-time highs, we'll likely see gold start to have a significant retracement and to break that recent move that has been bullish. So we'll continue to watch this pair very carefully. And other markets that track off the dollar very carefully is bonds. And we could very well see bonds take out these lows if the dollar makes a significant move as well. So watch these three markets. They could tell you an awful lot about what to expect across some of the other indices and so forth. And then, of course, volatility continues to be exceptionally low. Anything below a 12, we mark as this exceptionally low volatility. There is very little fear, and there's very little probability right now that the market will make a big move in either direction. Okay, let's go ahead and go to the daily report. And a couple minor changes here, but nothing of consequence, I would suggest here. Market trend, intermediate term phase opinion, still in market phase 4, still the expectation of these extension patterns. That is a bullish market phase. In terms of the three market timing signals, the first one comes from IBD, Investors Business Daily, confirmed uptrend is that signal. The second signal, 5 out of 6. Do note, it did tick down one notch on the GMI2, the more sensitive index. It's now 5 out of 8, but the buy signal does remain in place. That's been in place since 11:10. Stock charts, decision point, scoreboard. No change from yesterday. We're still sitting here with a virtually perfect line of bullish signals, with only the NASDAQ in the long term with a mixed signal. So almost the perfect stack. Obviously, the consensus of the market timing signals at this point is for a bullish signal. In terms of the market, position sizing opinions, both models are coming in at 100%. Intermediate term market posture is still on 3 of the 4 indices, an exceptionally strong bull. That's further supported by a strong bull sentiment line. We have started to see some erosion in the values, but they're still above 80. Now, the one exception is the Russell. The Russell did drop sharply below 80 with yesterday's action, down to a 73.6. So the Russell is in a weak bear on the intermediate term. Even in the Russell, though, given where all these other indicators are, these pullbacks are expected to be relatively shallow and relatively short in persistence before the next bullish leg likely flips back up and over. So just keep that in mind. Strength of trend continues to be good. Hedge warning status, a level 0 plus, the same level we've been at for an extended period of time. And this is defined as normal with some elevated conditions. And the elevated conditions are relatively mild at this point. What we watch for, of course, is change and rate of change. And you'll constantly hear me make reference to that. And we're watching for, we've seen some new warnings come in, and we'll watch to see if that accelerates. In terms of the strategy opinions, nothing new here. The main thing that we're focused on is we've got this as within acceptable range. We could toggle this back and forth or just flat out put an asterisk on this. We've been flipping back and forth between above 12 and below 12 on the VIX. 12 is our normal threshold for the initiation of new positions in the option income strategies bucket for novice traders. And of course, that's related to the relatively low premiums that are available. You often see yourself, if, for example, if you're picking a 10 delta, that 10 delta is really, really close compared to when things are more volatile and things start to spread out. So you end up with often going to higher deltas in order to get the amount of premium that you're looking for, and it's even closer than normal in terms of the number of points between where your risk profile really starts to tick up and your kind of normal expectations. So all this kind of makes for option income strategies to be a bit more tricky for those novice traders, and we note that. Cover calls, put selling, no changes from yesterday. In terms of areas of specific warning, most of this is continuing to be related to the expectation of, at some point, expansion of volatility. But this is a low-grade warning here. This is a low-grade warning at this point. The skew is a serious warning. It's up over 140. That gives us about a 13% probability of a 2 standard deviation move in the next 30 days. In terms of the trend-based indicators, we did get a warning here yesterday with the New York Stock Exchange new highs, new lows on the 1-month time frame, coming in with a 366 on the lows. You heard the morning author mention one of the indicators that they follow, the first time in more than 2 months that there were more new 52-week lows than 52-week highs on the New York Stock Exchange. That occurred yesterday. So, this is a significant warning here, but still, there are relatively few warnings. In fact, I'd really just paint, maybe 3 warnings here: the skew, this New York Stock Exchange, and one of the risk aversion indicators being as risk off. That's not a lot. And normal bull market ebb and flow, inhale, exhale, will give us these kinds of triggers when we're in a little bit of a pullback mode. And that's nothing to be concerned in and of itself that there is something bigger brewing. Now, if we start to see a lot more red painting here and this thing starts to accelerate, that's different. Sentiment, really everything relatively benign, and the fear and greed index at a 69. So this has actually been falling of late. This little bit of weakness has scrubbed off some of the excessive sentiment. In terms of sector specific, you see yesterday was a pretty weak day across all sectors, and in breadth within those sectors, not very many places to paint as being in a good day. Energy was the one exception, where you had, up about 1/3% and a little more than half of the components being positive on the day. In terms of who performed the worst, it seems to be, I would say, a mix of defensives and risk on, perhaps the financials and materials. Remember, these have been areas that have been relatively strong of late. In fact, come down here, we'll take a look at materials. The 3-month, they're up 4%. That's not terribly exciting, but financials have been up 8% and up almost 5% on the 1 month. So that performance, is the first to give up some profits, perhaps, when you are looking at a bit of weakness. So these areas, you see also utilities. Utilities has been a strong performer of late. Gave up very little of it yesterday. That, of course, being a more defensive area of the market. But still, the market, at least yesterday, was a bit more of a scramble of a mix of defensives at the top and defensives at the bottom. So not clear from that standpoint. Okay, I think that's probably enough for today. Let's go ahead and roll this thing up. I'm going to roll through a few slides here. Hit the pause button if you see something that you want more information about, more detail on. Also note there are hyperlinks indicated here that will take you to additional information. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide that will take you to the full set of disclosures. We'll see you back here probably Thursday with the next market preview. Or if something significant cooks up in the market, of course, we'll always go to a new market preview. In the meantime, manage that risk profile and good trading.